Imagine this for a second. You open your investment app one morning and realize you've quietly beaten most Wall Street pros. And you didn't do it by day trading, chasing stock tips, or staring at charts at 2 a.m. You did it by making one simple choice years ago. You picked a boring, steady strategy and then mostly left it alone. No drama, no next Tesla hunt. Just slow, quiet compounding happening in the background while you lived your life. That's the world of index funds. Instead of treating investing like a full-time hobby, index funds let you step off the treadmill, but still stay in the game. Think of it like this. You set up automatic investments into a fund that quietly earns more than most people's complicated strategies, without you babysitting every blip in the market. You're not trying to outsmart everyone else. You're choosing to ride alongside the broad market itself. It's like owning a tiny share of thousands of businesses, all working for you while you sleep, spend time with family, or focus on your actual career. And over years, sometimes decades, that quiet, systematic approach can snowball into real wealth. Not because you took wild bets, but because you consistently captured what the market was already offering. So let's slow down and ask, what exactly is an index fund tracking, and why should you care? Picture the stock market as a giant neighborhood of businesses. On one street, you've got booming companies. On another, some are struggling. Most are just quietly doing their jobs day after day. An index is like a map of that whole neighborhood, built using simple rules. For example, include companies above a certain size, or include companies from specific countries or industries. An index fund just buys that map. Instead of guessing which single house on the block will double in value, the fund buys a slice of the entire neighborhood. That way, as the neighborhood grows and improves over time, your money grows with it. Here's where index funds get really interesting. They don't try to predict the future at all. They just follow a simple recipe and let the future unfold. Think of an index fund like a slow cooker. You toss in the right ingredients, a broad mix of companies. You set the temperature, your monthly contribution. And then, you mostly leave it alone. The magic isn't in constant stirring, it's in time and steady heat. With an actively managed fund, there's usually a manager waking up every day thinking, what should I buy? What should I sell? With an index fund, it's different. It follows a rulebook. Own these companies in these proportions and adjust only when the index changes. That rules-based approach keeps trading way down. And when there's less trading, a few good things tend to happen. First, in taxable accounts, fewer trades often mean fewer taxes triggered along the way. Second, there are fewer chances for you, or a manager, to panic in and out at the wrong moment. You're not reacting to every headline. You're sticking to the recipe. Now here's another key idea. You can choose which neighborhood of the global market you want your money to live in. A total market index fund is like owning a tiny condo in almost every building in the city, from scrappy startups to giant global firms. You're spread out across the whole town. A bond index fund is different. That's more like lending money to thousands of borrowers at once, instead of just your one risky cousin with the big idea. It's still diversified, but in a lending world instead of an ownership world. Then you've got international and emerging market index funds. Those expand your reach beyond your home country, so you're not betting your entire future on one economy staying on top forever. So, total market indexes, bond indexes, international and emerging market indexes, they're all different neighborhoods. And you get to decide how much of your money lives in each one. Over time, index funds quietly adjust as the world changes. When certain companies grow, they become a bigger slice of the fund. When other companies shrink or disappear, they naturally fade in importance or get dropped when the index is rebalanced. You don't have to guess which new technology, brand, or market will be the next big thing. The index gradually tilts toward the winners as they prove themselves in the real economy. Let that sink in for a second. You're not making 100 tiny predictions. You're letting the real-world results of thousands of businesses slowly reshape your portfolio for you. The real superpower of index funds isn't excitement, it's reliability. You're building a system that keeps working whether you're paying attention or not. You move from asking, "What's the hot stock right now?" to asking, "How can I regularly add to this simple structure and then leave it alone long enough for compounding to do the heavy lifting?" Here's another way to picture it. Think of index funds like signing up for automatic payroll at work. Every paycheck, money gets routed to different departments: marketing, operations, research, without your boss renegotiating the split every single week. As some departments prove more valuable, their budget naturally grows. You're not micromanaging. You're trusting a system that reallocates based on real results. Or imagine a community garden. Instead of betting everything on one tricky plant, you claim a shared plot where dozens of crops are growing. Some seasons, the tomatoes explode. Other years, it's all about the leafy greens. You're not predicting the star crop in advance. You're just showing up regularly to water and letting the mix of plants and the changing seasons work in your favor. Index investing is also a lot like subscribing to a streaming bundle instead of buying individual movies. You don't know which shows you'll love over the next decade, but you do know the library will keep updating. Weak titles will fade away, new hits will be added, and all of that happens with no extra effort from you. As more people invest this way, markets start to feel less like racetracks and more like public transit systems. Fewer solo drivers zipping around trying to outmaneuver each other. More people sharing the same broad routes. That can lower the number of traffic accidents from really bad stock picks. But it also means those smaller, overlooked side streets, niche stocks and brand new listings depend more on active investors to notice them, set prices, and keep markets exploring new paths. So, index funds don't replace curiosity or research in the market. They just give you an option to participate in the whole system without having to be the one driving down every side street yourself. In the end, index funds are a lot like installing a reliable solar panel on your financial roof. They're not flashy, no fireworks, but they quietly harvest the market's sunlight year after year. You still choose the angle, how much you invest, how often you add more, and how long you leave it there. But you're no longer chasing lightning. You're wiring your future to a steady, renewable source of growth. All right, let's pull this together with a quick recap you can actually use. So here's what we covered today. First, index funds let you own a slice of thousands of companies, or bonds, at once, instead of betting everything on a handful of picks. You're buying the whole neighborhood, not just one house. Second, they follow simple rules instead of predictions. That rules-based, slow-cooker approach means less trading, fewer chances to panic, and a better shot at letting time and compounding do the hard work. Third, you get to choose your neighborhoods: total market funds, bond funds, and international or emerging market funds. Together, they can form a simple, diversified core for your whole investing plan. And fourth, index funds quietly update as the world changes. As winners grow and losers fade, the index reshapes itself, so you don't have to constantly guess what's coming next. Now, what can you actually do with this? Here's your action plan for this week. Number 1. Take a few minutes to jot down the key ideas you heard about index funds today. Just a handful of bullet points. Writing it down makes it way more likely you'll remember and act on it. Number 2. Look at your own situation and identify one specific area where this knowledge applies right now. Maybe it's your retirement account. Maybe it's a taxable brokerage you barely touch. Maybe it's the cash that's been sitting on the sidelines because you weren't sure where to start. Number 3. Take one tiny, concrete step to apply what you learned. That might be researching a total market index fund from a reputable provider, checking what index options your workplace plan already offers, or setting up a small automatic monthly contribution. It doesn't have to be perfect. It just has to be a step. If you do only those 3 things, write it down, connect it to your life, and take one small action, you've turned this episode from interesting information into real financial progress. And that's the real power of a simple strategy like index funds. Not that you understand it, but that you actually use it.